Hey, welcome to the Founders Mentality. I'm Josh Feedy. I'm super excited to introduce everybody to my next guest today. This has been an advisor to me for pretty much the entire 2 years that I've been building the company that I'm building right now. And he is a tremendous resource for any of the local startups here in Minnesota. And I want to talk about kind of his experience from a legal perspective, because this is a really important thing for any founder starting a business, whether this is your first, second, or third business, is making sure that you have the proper legal resources in line. So everybody, please help me welcome Chris Carlisle. I'm going to let him introduce himself and talk a little bit about his past here. So Chris, welcome to the show.
Thanks a lot.
Yeah.
Gosh, it's great to be here.
Absolutely.
So I'm Chris Carlisle. I'm at a law firm, Great Plant Mooty, which is a 175 lawyer firm in town, the oldest firm in Minnesota.
Is it really?
For what that's worth, for our technology friends out there.
Nice.
I have been practicing for 18 years. I've been at the same firm for that whole time.
Wow.
Somehow that managed to work out.
Yeah.
That's pretty fun.
Yeah.
My focus and my practice's focus is emerging companies and technology businesses. So really work with entrepreneurs of various stripes, helping them succeed in business and life, trying to figure out how they set their business up, how they finance their business, how they do whatever they need to do from a legal perspective to make sure things work the way they work.
Right.
Yeah.
So 18 years you've been doing this.
Yes.
When you started 18 years ago, what was your position? Did you know right from the get-go that you wanted to be involved in emerging technology and startups, or where did you kind of start?
I didn't. So when you start at a bigger law firm, you're sort of assigned to where you're assigned. And I was assigned to the corporate group. Okay. And when I started practicing, I did worked for a lot of bigger companies. So I did a lot of work for Xcel Energy. Okay. I did a lot of work for NRG, which used to have a big presence here. It doesn't have a big presence here anymore. It's in New Jersey now. And another one of the clients that I did a lot of work with was Lawson Software.
Okay.
And Lawson was sort of a historical enterprise software company here in Minnesota, had a big presence still has a bit of a presence here in St. Paul. And ended up being on their deal team. Okay. This was, sort of the early 2000s, if you will. Yeah. And they were doing a lot of sort of value acquisitions in Silicon Valley and in California. And so was doing a lot of due diligence on those deals and learned that sometimes companies were financed through Series G, and sometimes Series G was the only round that got any money. And so that was sort of my first entree into sort of emerging company land. And then my firm has a number of folks that focused on emerging companies and venture finance. And eventually I migrated to that. I mean, that's what I was interested in. That's what I tried to sort of angle my career towards. And, law firms are big places, but you try to sort of work with the people you want to work with. And eventually my practice focused exclusively on entrepreneurs.
Awesome. So, so how long ago did that transition then take place?
So I started at the firm. I was a clerk, what we call a summer associate, in the summer of 2000. Okay. For those that are too young to remember, there was a tech boom and bust.
Yes, there was.
In late 1999, early 2000.
Yep.
So I was hired at the apex of that boom in the fall of 1998. And by the time I got to the firm, the tech community was cratering, and actually, frankly, we were entering into a recession. There was a lot of dark times at that point, and there wasn't a ton of M&A or finance activity to speak of. From then until about before the second recession, or the first one for a lot of your audience, right? Yeah. Was sort of my evolution from the bigger companies into the more emerging company space. Okay. And so did a lot of private equity and venture work sort of in that kind of leading up to the 2008 and 2009 and Lehman Brothers, et cetera, et cetera. Yeah. And then was really exclusively focused on it by 2010,
Yeah.
by 2010, 2011 or so.
Okay.
So-
Okay. And so I remember both of those recessions. I'm old enough to have lived through both of them with you as well. They were a lot of fun. The first one, I was too young for it to really impact me in any meaningful way. I was, I think just graduating high school right around that time, starting in the true workforce. The second one is when I actually launched my first business, which was a really crazy time to start a company. But it was actually like a year into that recession that I said, we really need something to shake things up here. We need something a little bit different. Tried something different. It was a lot of fun for a couple of years, and then it wasn't fun at all. But regardless, one of the things that I learned going through that process was all of the things that I didn't know and all the things that I needed to learn before I ever ventured out and started another business, right?
Yeah.
One of those key things for me was the importance in having a lawyer in your court that can really help you through the legal pieces that I'm no expert in, and I don't have a desire to be an expert in. I network with a ton of startup founders in this town. I can't even name one that. Nope, that's not true. I can name one that would say that they have a legal expertise in their court. I can name one. That's it, right? And so for me, the discussions started really early on with you, even before I had raised any money, before I had even started developing the product. I started talking with you about this is what I'm going to be doing, and these are the things I'm going to need you for, trying to align myself with the best lawyer I could possibly get. Now, a lot of people listening to this are probably saying, geez Louise, Josh, you're like the most spoiled person in the world. Like you went out and you got a lawyer from like the oldest, most recognized law firm in Minnesota. This can't be cheap. We will not discuss details of that. However, I will tell you this, and I will tell any startup founder that's listening this, that bringing you on was the most impactful thing for my business because it gave my investors so much trust in the process.
Right.
There were not as many questions being asked as I thought there would be. And we were able to do some things so far that I think have been pretty amazing for a company that's only been around as long as we have. So I thank you for that. But for anyone listening, it's an incredible thing to have in your court. Now, when we're talking about startups, and maybe there's a difference between first-time founders or multiple founders, but maybe let's talk a little bit about first-time founders. And do not mention any details, obviously, because you can't. But first-time founders, what are some of the early mistakes that you spend most of your time trying to guide first-time founders through when they're launching their business and maybe getting their vendor contracts together or just starting to raise money or whatever it might be?
Yeah. So a couple of things. I mean, number one, I think there is a misconception out there that, the early stage legal is going to be prohibitively expensive, whether it be Great Plan Mooty or somebody else. And it's actually not true. I mean, the nice thing over the course of my career that has happened in the startup community is that there's been a lot of standardization. There's been a lot of form sets with folks like Y Combinator coming out and, sort of frankly institutionalizing how financing happens, how formation happens. Some West Coast law firms, sort of contributing to that and creating form sets and, really standardizing the product. So it's not, okay, if I go to lawyer A, I'm going to get, $30,000 worth of monkey business, and if I go to lawyer B, I'm going to get $5,000 worth of monkey business. I think if you go to somebody that practices in the startup space and the emerging company space, I think the good news is if you get one of those folks, you're going to get something, you're going to get a consistent product and you're going to get a consistent price point, whether it be at a firm like ours or whether it be a two-person, startup focused shop. Some of the things to think about and really focus on when you're starting. So I see a lot of startups that form the company on their own and don't spend any time with a lawyer or with themselves trying to figure out what the relationship is going to be amongst the founders. In other words, what's going to be the allocation of equity between the founders? And then I'm a huge proponent of this. you have to have vesting of some stripe.
Yes.
And figuring out what that vesting looks like relative to the different founders and the different founder contributions. And there's many permutations on that, depending on how many founders you have, what they're contributing, how much time and energy and effort they're putting into the business.
Yeah.
So, but the key concept for your listeners to take away is, there's 4 founders and they start, building a business, and one of those founders decides, well, geez, a year later, my wife got pregnant and I'm just tired and I want to go get a real job, or whatever the case may be, that their equity ultimately, or a significant portion of their equity, is going to come back to the business. So we can take that equity and give it to either give it to the existing founders or give it to another founder or future employees that are going to ultimately help start the business and help move it forward.
And I fully believe in that as well. And that is exactly how we structured my business as well, per your instruction.
Yeah.
And I think that it was brilliant, right? So, it really allows me to make sure that I always just have my foot on the gas, right? And you never know what's going to happen, right? I could get sideswiped any day now by one of the contractors that came on early that's helping me build my product, who might just say, look, other things in my life have taken off. I got a bolt. Yeah. If I give up all that equity in the beginning without having any of that ramp up, right, then I can't pivot. I can't bring someone else on that's going to be enticed by equity, because I can't give up any more equity at that point.
Right.
But additionally, I think just at its core, the most important thing is just having everything detailed before you start going, right? Yeah. I mean, this is the whole reason that a prenup exists, right? Like, let's just make sure that worst case scenario, we all agree right now, before we get too far into this, that this is what's going to happen.
Right. And timing on the prenup analogy is a good one. Yeah. I mean, the timing is really important, right? The timing on getting your vesting together and figuring out what that relationship is and what that deal is not when you have your first financing term sheet, right? I mean, not that it can't be worked through at that point, and sometimes it is. Yep. But you want to have those hard conversations with your co-founders at the beginning of the company's existence, so that things are kind of easier when you're starting out. The other thing that's pretty important on this sort of thing is, and this is sort of a technical point, but when we're starting a company, it doesn't have a lot of value for tax purposes. Right. And we want to make sure that when we're doing these grants and we're figuring out what founders own and don't own, that they're having nominal tax value at the time that this equity is issued to them. Right. And that gets tougher as the company grows and as it increases in value. And when you get a term sheet for $5 million you're all of a sudden you have a company that's got value, and it's frankly too late to file what are called 83B elections. I'm not going to get into the technicalities of it, but the gist of it is
everybody's falling asleep already.
Taking a nominal amount of tax into income versus taking a lot of tax into income. Right. So that's something we really want to make sure we're getting right at the front end of things.
Okay, so one of the other things that you mentioned in the beginning there that I see a lot, and you're totally right, and I'm so glad you brought this up. There are so many forms that exist out there already to just help kind of speed up this whole process of getting your business as an entity, right? Legally, getting everything drafted up. Yep. I see a lot of startups that say exactly what you just said. We're going to save money. We're not going to spend money on a lawyer, because in the beginning, all we really need are these contractor agreements. All we need to do is, get our business properly assembled, do all this stuff. We can do this ourselves. What are some of the pitfalls? And I'm not trying to scare anyone away from doing that. This is not an advertorial for like working with a big law firm by any means, but what are some of the pitfalls that you've seen of companies that have started that way, kind of doing it themselves?
I think it's, we're all trying to lever the expertise of ourselves and of others. Yeah. And I think there's some great resources out there, and I love it when founders come to me with, having read Feld Thoughts or avc.com and have really done their homework on what's out there in the community. Yep. I mean, I think that's great. But when you're using LegalZoom or when you're using, the Cooligo form set, there's lots of choices that sort of are brought along the way. And I think, it can be too easy to sort of say, okay, well, click. Let's just sort of figure that out.
Right.
And then we wake up later and we haven't done what we were supposed to do, or again, we've negotiated something, or we haven't really carefully looked at the deal that we've negotiated.
Right.
And we don't have somebody, I mean, it may sound pretty simple, but just frankly, reading and rereading the documents to make sure we've got the deal that was ultimately struck.
Yeah.
And
yeah.
the founders, I mean, that's not their business. I mean, their business isn't to read, frankly, boring legal documents to figure out whether they say what they're supposed to say.
Right.
And not that there's anything particularly magic to it. There isn't.
Sure.
But at the same time, having that value when you're really trying to, like, let's be honest, we're trying to build something that's going to go beyond ourselves.
Yeah.
And if we're successful, there's going to be a lot of wealth creation there. And so think about it that way, in the sense of this is really important stuff if we are successful. If we're not successful, maybe it's not, but that's not what you're in. That's not why you're starting a company, is to not be successful. Right. You're starting it to be successful.
Right. Well, and kind of the way I broke it down for myself, and I don't know if this will help any of the listeners as well, but so I'm building a tech product, right? And so when you're building a tech product, you have your backlog of future development releases, right? Yeah. And you plan those out very strategically, right? Because you can't launch one thing without considering how that's going to impact things that are going to come down the road. If you have people using your product, you can't make this huge change and blow everything up and say, sorry guys, start from scratch. Right. It doesn't work that way. And that was kind of my fear when I first started thinking, and I'll admit, and my first thought was, I'm just going to go online and find everything I need and do these forms myself. But the problem with that is that I'm not an expert. And I couldn't see what the future of this decision might be. And I think that that's where there was a lot of value in working with you and your team, was having people that could break down for me, okay, Josh, yes, you can do that. But 5 years from now, if this happens or this happens or this happens, then that was the wrong decision. Right. And what we should probably do is this, because in 3 years, this is going to turn into this, and this is where it's going to make the most sense. Those are things, if you're not an expert, if that's not what you do every single day, you're not going to know that.
Well, and just like in the technology world, the universe changes, right? And so when I started practicing law, a lot of capital formation was done by registered broker dealers, and we would do these things called private placement memorandums, and we'd spend a lot of money on those, and we would. They were very, very fancy, and we would then, those brokers would go out and into the world and sell your shares, and hopefully it was successful. Oftentimes it was not, but there was a lot of upfront cost to that, and that created a lot of trepidation amongst folks that okay, well, this is not really the way to go. Fortunately for me and the community and everybody else, we moved away from that, and now the documentation has gotten a lot simpler, a lot more straightforward. But it's also changing and iterating, and a lot of the times what we're trying to do is we're trying to create a document set that investors and other people are going to look at and go, okay, they know what they're doing. Everything's ticked and tied. We're comfortable. We know what the founders' relationship are with each other. We know what the founders' relationship are going to be with us. And everything is sort of, check the box, if you will.
Absolutely. I mean, it has helped me in raising money, right? One of the number one questions that I get from startups here in Minnesota is, can I get some advice around raising money? And honestly, the first thing I tell them is get a good lawyer. Right? Because for me, I'm not discrediting any of the work that I've put in to raising the funds, but at the end of the day, when you're talking about collecting a large check from an individual, when you tell them that the person that's helped me craft this is an expert, they know what they're doing, I'm just following their instructions, and I put them in contact with you, every single time it's been a no-brainer. It's been a simple 15-minute conversation to just go through the forms with you real quickly. In our recent seed round, we even put in the ability for the investors to put the documents in front of their own lawyers, and we were going to refund them for the time on that. Not a single one of my investors even put this in front of their own legal team because they felt so comfortable with you, right? We didn't pull a fast one by any means. It's just that's how comfortable they were in the situation. And it was great, right? So I think all that's completely invaluable. Okay, so another thing that I want to talk to you about, first I wanted to ask you, because I've never asked you this, Do you focus solely in Minnesota, or do you have startups in Silicon Valley or outside of Minnesota that you're working with?
Yeah, great question. So we're pretty much focused in the upper Midwest. So we have clients, pretty active client bases in Wisconsin, North and South Dakota, Iowa. It really kind of depends on where the company goes, right?
Yeah.
I mean, we've had startups that have started here, and then for whatever reason they got funding in Silicon Valley, or they've moved their offices, they've moved a part of their offices there, and we've maintained the relationship. So things like that. I do some investor side work as well, and sometimes we will. Post-investment, we'll be engaged by counsel, or we'll be engaged as company counsel. And so we've got some clients that sort of are far afield, Texas and Florida and what have you that way. But we're really focused in the upper Midwest. But that said, and this is, again, the nice thing about startup work is that there's there's an institutionalization of it all, right? And again, so you mentioned your seed round. I mean, your seed round was done with the Series Seed form set, which is produced by Fenwick and West in Silicon Valley, and has really kind of become the gold standard for that type of financing. So, I appreciate that folks get comfort that I represent you and represent folks, and that I've kind of done things the right way. But I think it's also a bit of a, okay, well, this is a pretty standard seed deal. We know what it looks like. We know the rights we're getting. It's right down the middle of the fairway. Fair to the entrepreneurs, fair to the investors. We want to minimize the friction with investors as much as we can, because it's a partnership. It's not as much as we possibly can. We don't want to make it adversarial.
Well, okay, so that might be true, but let's go back to my pre-seed where we actually structured the deal with the SAFE, right? So that was Y Combinator. What is that? 5, maybe 6 years old at this point, that document. That is not the most common document for raising funds right now. And even that was flawless, right? So, I mean, yes, it's already documented. This is how it looks. This is how it goes. But it's not something that a lot of the investors, especially in Minnesota, are comfortable with. I would say on the coast, from what I've heard, a lot of them are very familiar and very comfortable. Just hasn't really picked up as much here. Okay, so along those lines,
before you go there, I mean, just real quickly, I mean, people hear the phrase SAFE. It stands for a simple agreement for future equity.
Right.
It's sort of a corollary to a convertible note. Oftentimes, early stage companies will raise their first capital in a convertible note or a SAFE. They're really kind of the same thing, just different, a little bit different legally. And they essentially convert into the next financing, whatever that is. Safes are they're a bit of a different instrument. They don't have the features of a note. Sometimes investors, particularly in the Midwest, want to see a note because they know what a note is, and it's very clear what a note is, and we're dead, and at least we're dead in the first instance. And sometimes there's a bit of an education process with investors, but depending on how sophisticated they are, in terms of what a SAFE is and what the differences are. But they really sort of act in the same way, which is to essentially be a placeholder, so we can not get into an argument over what the company's worth today. We can punt that down the road a little bit.
I mean, already in the first 25 minutes, you've given away at least a normal hour's worth of advice. So and you cannot give away any advice. So that's not what you're doing. No, I'm kidding. But okay, so this is great. We're getting close to the end of this one. But one of the things that I wanted to kind of dive into, knowing that you're really focusing in Minnesota, that's exciting, because I've seen the startup space in Minnesota change dramatically in the last 10 years. And that's the bulk of when you've really been focused on the startup scene. So, I mean, what are some of the exciting things that you've been seeing over the last 10 years happening in Minnesota in the startup scene?
I think the biggest thing that's happened, and this is not just in Minnesota, but across the country and just in technology generally, is that the costs of building a technology business have gone down pretty dramatically. And so what that's meant for the community is that founders that have a great idea and a great principle can get going on their business with a lot less capital, and that means that they can get traction a lot earlier and move the ball forward a lot earlier with the product and with customers without a ton of money.
Yeah.
When I started, you're doing these angel rounds of $2 million, $3 million, and we really don't do that anymore. We do founder, friends, family, and fool rounds of couple $100,000 to maybe $500,000, and seed deals in the $500,000 to $1.5 million maybe. And that's really allowed, I think, the community to thrive, and it's allowed technology communities around the country to thrive. And that's been really exciting.
Yeah. I love that. I love that. No, and Thompson, I had Thompson on, who's one of my favorite local startup founders, right?
Yeah.
And that's one of the things that we spoke about as well, right? So you're talking about you don't need to raise as much as you used to. Thompson's point was you don't even have to raise if you don't want to. I mean, especially early on, you can get a lot done with open source software these days if you're working in a technology space without even bringing in any money, and really at least get the validation from your customers that this is going to move forward properly. So, I mean, are you seeing tell me the mix. Are you seeing a lot of people coming to you that have done sort of that, where they've kind of put together something utilizing open source softwares and maybe gotten it to a viable product and then they're trying to fundraise? Or are you still seeing a lot of people coming very early on with just the idea that are looking for fundraising at that point?
Well, I think the biggest question in trying to help early stage clients develop their finance strategy is really about, what are we trying to do here? Are we trying to hit a grand slam home run? Is it a giant market that we are, really want to go after, and it's really about first to market, and, it's going to be about, run? Or is it going to be more of a slow burn, and I want to maintain as much of the equity as I can? It may not be as big of a business. It's not $1 billion idea. It's a $20 million or $30 million idea. Still a great idea. But just it fits in a different mold. And I think that's if it's really about that and the kind of business you want to grow, and how quickly does that business need to grow.
I love that. Thank you so much for being on the podcast here, Chris. I hope that everybody listening found value in that. I mean, there was a lot of really great information in there as far as structuring and the different documentation that's out there. And I would just reiterate that one of the most critical things that I did was find a great lawyer early on. I think that everybody should have that. You've been tremendous as far as responding to even text messages when I have quick questions, right? And I haven't seen the response to text messages on my invoices, so I believe that you're just letting me have those ones.
That's a secret.
And I appreciate that one. I try to keep them to a minimum. But every once in a while, when you're in the middle of a deal, something comes up and you have to ask a quick question, and not having to wait till the weekend is over for a startup founder is really important, because we're all working weekends as well, right? The other thing I would say is thank you so much for the support that you give to the entire startup ecosystem. One of the big things that I did when I started this business was I said, I want to support the kind of companies that support what I support, right? So I went with Great Plant Mooty for legal resources, because you were at a lot of the startup events that I was going to. You personally were there. It's the same reason I went with Flagship Bank, right? Andy Shornack of Flagship Bank was at every startup event that I was going to, right? It wasn't the most convenient bank for me as far as proximity to my house, but it was the best bank for me as far as they get it. They understand that I'm a startup. They want to be a part of this, and they're excited about it, right? I think that's really, really important. So, okay, moving forward here, if anybody wants to get in contact with you, if they're either looking for a new lawyer or they're looking for their first lawyer, what's the best way to get in contact with you? Email, LinkedIn?
Any of the above. I mean, you can find me on our website, which is gpmlaw.com. You can text me, you can email me. I mean, on LinkedIn, I get a lot of LinkedIn contacts, whatever works.
Yeah, awesome. All right, and then thank you so much again. I mean, I got to cut this one off because we're at the 30-minute. That's what we do. We try to keep it under 30 minutes every time. No, but I really appreciate this, and maybe we're going to have you come back. If anybody has any follow-up questions that I didn't ask that's really just burning, right? Maybe we'll have you back in like 6 months or something. We can compile those and we can just answer those questions as well, because I'd love to have you back on.
Yeah, that'd be great.
But regardless, thanks everybody for joining us today. We'll be talking again in a couple weeks. We release these episodes on the 1st and 15th of every month, so we'll talk to you guys very soon. And our next guest is going to be Rally Registry, which I'm really, really excited about. And just a little heads up, we're going to take a little bit of a break here. I'm going to take an additional 2 weeks in between our next episode because I'm moving into a new space. I need to get set up properly before I start recording these. So give me a little bit of time here. Our next episode will actually be a little bit delayed, but that's fine. It'll be Rally Registry and it'll be a ton of fun. But thanks again, Chris, and have a great day, everybody. Bye.
Thanks, Josh. Bye-bye.